I'm Sam Slater from FundCalibre, and you're listening to Investing on the Go. I'm here today with David Coombs, manager of Rathbone Strategic Growth Portfolio. Hi, David.
Hi.
So you've managed this fund for about 10 years now. What have been the high and low points of the past decade for you, and what have you learned along the way?
High points, low points is difficult. The fund, the way we run the fund is that it's meant to produce consistent returns. So we're never shooting lights out. We're never kind of going through the floor. I mean, everything's been a 10-year bull market since the financial crisis of 2008. It hasn't been. Taper tantrums, yield curve inversions. There's been lots of sort of market blips over that period that have been, challenging to get through. The highlights have been to see the fund get through $500 million towards the last 2 or 3 years. It's been a long slog, a lot of sort of presentations in hotels around the country trying to get people interested in this type of strategy. And finally, we seem to be in the sweet spot where multi-asset and targeted return and risk are much more in vogue than they probably were 10 years ago.
So you've mentioned target returns there and risk. So this is a new type of fund where you actually think about risk first and then the returns that you can get from it. Is that correct?
Not exactly. This fund has two targets that are equally weighted, the risk and the return. So if I hit the risk but not the return, then that's not acceptable. And if I hit the return and take too much risk, that's also not acceptable. So they are weighted 50-50 in terms of how I look at the funds, and probably equally importantly, how I'm remunerated.
You split the portfolio into 3 buckets. There's liquidity, equity risk, and diversifiers.
Yes.
Can you explain what you mean by each of those, please?
Yeah, I mean, when we're targeting risk, for example, we're looking at relative volatility, but really we're talking about drawdown, because that's what clients really get nervous about, is when you have stressed market conditions and your investments are going down. So what we're trying to do is manage the downside. We think managing liquidity risk is a key part of that, if not the most key part of that. So the liquidity bucket contains asset classes that we know we can sell during those distressed market periods. We don't look at average daily market liquidity, we look at liquidity during stressed events. The L bucket is only investments that we have high conviction and confidence we could sell them during those market stressed events, but also they will probably produce a positive return, i.e. they're negatively correlated. What's in there? Mostly sovereign bonds, but AA rated credits and above as well, and cash, of course.
And the equity risk, is that shares in companies?
It's everything that I didn't just describe, I guess. It's clearly it's equities, it's fairly obvious, but it's also credit, high yield, emerging market debt, corporate bonds below single A rated. Again, any investments which we think may be illiquid, may have a high correlation to equities during those market stressed events, because a lot of multi-asset funds have lots of diversification in terms of asset class and sectors, and they don't really stress test their portfolios. They just look at long-term correlations. We don't do that. We look at correlations and liquidity and downside risk during a, say, 20, 30, 40% collapse in equity markets.
Okay, thank you. And in that equity risk section at the moment, you've got what looks like an eclectic mix of shares and holdings at the moment, at least at first glance. You've got the likes of Estee Lauder, the makeup company, LVMH, which is Louis Vuitton and Moet Champagne. ASML, it's not even a chip maker for phones or computers, it provides the bits for those chips, for those phones and things. So is there a theme I can't see, or how do you go about picking those particular holdings?
We're not thematic investors particularly. I don't sit there going, I must have an investment in makeup theme, for example. We own Ulta Beauty as well, just to take that forward. I think what's really important is that we have 40 or 50 companies in the portfolio, and they're all weighted accordingly. There's no top 10. In strategic growth, they will typically be between 0.7 and 1% of the portfolio. That's part of our risk discipline. So that's the first thing to say. Secondly, what would they have in common? They would have a management team that we feel has the culture that's appropriate, i.e. they're willing to be challenged. We don't want CEOs who are huge personalities that aren't going to be challenged by their management team, because that's where you tend to have risk and poor allocation of capital. So the culture of an organisation, how they empower their senior managers, is really important. So there'll be a strong culture, management culture within all of the companies we invest in. But probably the most important thing they'll have in common is that they put the customer at their priority of stakeholders. Now, a lot of people talk about stakeholders in terms of shareholders, in terms of employees. We think the most important stakeholder is actually the customer, because if you don't get that right, your employees will struggle, the shareholders will struggle, management will struggle. Okay, so it's really important that all those companies focus on the customer, what customer wants. So, for example, Estee Lauder, as you used the example,
yes.
they are looking at reducing plastic use and moving towards glass because they are seeing a huge shift in consumer behaviour. Okay, that's a company that clearly is up to the minute in terms of what their consumer wants, desires, and is moving accordingly. Even if that's going to cost them money to do so, they're taking a long-term approach. So customer focus, customer service, absolutely vital, whether it's a business-to-business or it's direct-to-consumer business.
Thank you. And just going back briefly to the liquidity bucket, you hold some things in there called Treasury 0% T-bills that actually, we're talking in June at the moment, they expire next month.
Yeah.
So they're quite short-term. What are they exactly?
So they're short-term government borrowing, like gilts, if you like, but they're less than 1 year typically to maturity. They're a way of us investing cash for a better return than cash when we're feeling that the world is a bit risky and we want to hold more liquidity. You know, in strategic growth and some of our other funds, we have very high levels of liquidity at the moment, which reflects the risks of trade wars, political interventions, and the other macro factors and Brexit that everyone's aware of. So we're running high levels of liquidity, but we don't want to just hold cash. So by holding treasury bills, which are government bonds effectively, we're not taking any bank risk or credit risk, and we're maximising our risk return on cash, if you like.
So when they do expire, would you simply go and get another one that expires in another 3 months? Or
yes, correct. Or maybe up to, depending on where rates are, they may be slightly longer. And sometimes we might buy a 2-year gilt instead. It will really depend on the value of where the best rate is for maturity based on our views. So we will have UK sovereign bonds from, say, 1 month right up to 2 years as part of that sort of alternative cash position when we want to have high levels of liquidity, such as now.
Okay, thank you. And in the diversifier bucket, there's just a small amount at the moment, just 5%. Perhaps you could explain why that is and what you've got in it. I see there's something called an S&P 500 put. Could you perhaps explain that one?
So the 5% really reflects just the nominal value of the investments, how much money we've got invested there. But actually, what the S&P put does, at the moment, our position covers 20% of the equity risk. So its actual coverage of the portfolio is higher than 5%.
Okay.
So it's slightly misleading. One of the big advantages of scale, and as the funds have got bigger, is allowed us to enter into more sophisticated ways of managing risk, and put options are a way. So an S&P 500 put, effectively, if you buy, say, a put at S&P at 2,500, if the S&P falls below 2,500, we can still sell at 2,500.
Okay.
So we isolate the losses below 2,500. What are the advantages? You have, again, an absolute number that you have 100% confidence that risk beyond that you are not exposed to. So you're not hoping, like a hedge fund, that they'll be uncorrelated. This is a guaranteed negative correlation to equity risk. It's a bit more expensive than other forms of insurance, but the way to look at it, and the way to your investors look at it, we're buying insurance for the portfolio. Like all insurance, like house insurance, you hope to lose money on it.
Yes.
Because if your house insurance investment pays off, you haven't got a house, it's just burnt down or flooded. Okay? And it's the same with S&P puts. They work in exactly the same way. They isolate you from that risk. If we covered 100% of the portfolio with those put options, we would have no US equity risk at all.
Right, okay.
Now, we don't do that. We just, depending on, again, how we feel, last year we were 50%, to at the moment we're 20%.
Okay. And just going back to last year when we met, you were one of the few people who was still very positive about the US. The market had risen quite a lot at that point, was looking a little bit expensive. But you, I think you said that you thought it was probably going to be the best asset class in terms of returns, definitely over the next 10 years, but perhaps even over the next 1, 2 or 3 years as well. Is that still your view?
100%. Yes, I would dispute whether it's expensive, actually. I think if you compare the US market on a sectoral basis, you know, technology is 1% of the UK market, it's nearly 20% of the US market. Often people aren't comparing like for like. And also, if I compare the valuation of US banks versus European banks, we're talking about completely different types of institutions with different qualities of management and history. So I think looking purely at a valuation on a PE level between markets is fraught with danger, and it's not something we look at, to be honest. I would argue the US equity market, I'm not arguing it's cheap. I'm arguing it's good value.
Okay.
In terms of the transparency of the future earnings. And yes, I am still a buyer. I still have a bias towards it. I have no doubt that will be the case in 6 months' time as well.
Brilliant, thank you.
You're welcome.
If you'd like to listen to more of our podcasts, please subscribe to FundCalibre. Please remember we've been discussing individual stocks to bring investing to life for you. It's not a recommendation to buy or to sell. The fund may or may not still hold these stocks at the time of your listening.